Hello, I'm Greg Bell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up, we got U.S. markets assessing Nvidia earnings. Investors are weighing whether the AI build-out can continue to offset the concerns we have around rising oil prices. Macro, it's a tough environment. At the same time, weakening market breadth and rising downside hedging activity are raising new questions about how much upside remains in this rally. In just a few minutes, technical analyst and options strategist Bob Lang is going to join us. He's going to break down the key levels he's watching, what options markets are signaling, and whether this rally has some room to run. Then later, we're going to take a closer look at Decker's Outdoor ahead of its earnings. Can the maker of Hoka keep its momentum running? Are the expectations getting too stretched? That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. The trading session. Let's check in on the S&P 500. This is a market that has been very sensitive to oil prices and bond yields. Yesterday, a big pullback in the price of oil. Bond yields eased. The market rallied. Today, we got oil ticking a little higher. The bond yields are ticking a little higher. So you put that in the calculator. We got stocks a little bit lower, but they are sort of coming off the lows of the session right now in the early going. We're also looking at a lot of earnings continuing to roll in. Let's jump into the heat map. I should be able to find Walmart on you. There it is right there. WMT down almost 8%. The retail behemoth issuing a worse than expected financial outlook. They're pointing to soaring gas prices. They actually talked about how in the previous quarter, the quarter that just passed, they reported it was a decent quarter. They think big tax returns actually helped cushion the blow, but they're worried that Americans who are paying more for energy are going to spend less in Walmart, and the market is hearing those concerns with the stock at $120 down almost 8%. But Nvidia, let's talk about the big one. Sales up 85% to $81.6 billion for the quarter. That's a 3-month period, $81.6 billion. They're raising the dividend. They're announcing an $80 billion share buyback. The stock is pretty much flat, though. They're talking about growth. And perhaps there's some concerns here around the AI growth. Can it continue like this? They're saying they're going to get outside the hyperscalers at some point into business and to government. But right now, the market's just saying, okay, shares are roughly flat. And that's your market update. Joining me now is my colleague Hiran Amin from our direct investing educational team, and Bob Lang, founder and chief options analyst at Explosive Options. Gentlemen, thanks for being here. Before we dive into the conversation, just want to remind our viewers that the views and the forecasts expressed are solely those of Bob and his team at Explosive Options based on their research. Bob, I just ran down the Nvidia numbers, another massive quarter, so much hype going into it. The stocks, it's not really doing all that much off of this information. What is that telling you about how the market feels with the AI trade right now, what they need to see from these names?
Well, great to see you, Greg. So what I would tell you this about Nvidia, having had such a large run from the beginning of May, it was up about 13% leading into the print yesterday. Maybe perhaps, and I think this is true, that the stock already ran in front of the numbers. I think if the stock had been sitting at around 200, maybe 195 to 200 yesterday, we probably would have had about a 10% move up today, but we didn't get that. It looks like apparently investors and traders decided to jump the gun before earnings came out. The earnings were fantastic. The guidance was great. The buyback was strong. They instituted a huge increase in their dividend. And I think big institutional investors are waiting for a little bit of a pullback here to get back add more shares of the stock. I do think that there's nothing better right now than Nvidia out there in the AI world.
So that's Nvidia itself, of course. Nvidia, people look at it as sort of a bellwether of the larger AI trade. It was interesting yesterday, at least it was only one session, but Intel, AMD were making big gains while Nvidia was, just making small gains ahead of their own earnings. What's the feeling right now in terms of the broader AI play, whether it's the memory makers, the chip makers? We all got the upside priced in already?
Yeah, I think there's a lot of potential here for some of these other names that are tangential to AI and to Nvidia. I think in Nvidia, there's a lot of collateral moves today. You see ARM Holdings, which is up huge yesterday. It's following through for more upside today. You're going to see Broadcom also picking up a nice bid on this stock. They do have earnings coming out in a couple of weeks, so I think that investors are waiting a little bit to see what their earnings are going to look like. You're seeing some good action since earnings on Intel. There's a whole host of names out here that are going to do very well. And even today, Greg, we've seen some strength in some of these quantum names, and I know that this is a new area for a lot of people, but these quantum names, including IBM, are really rocketing up here. And I know that Jensen Huang, CEO from Nvidia, did mention last year that he thought quantum is definitely something that they want to continue to develop chips for and get involved in. There are some out there who think that it's 5-10 years out. Guys like Jensen Huang thinks it's a lot sooner than that. So this could be the next big thing for them too.
And Bob, we're just going to sort of look at a broader look as well. Like when we pivot to the charts, Greg mentioned S&P 500 kind of sitting at that 7,400. I think we're just shy of that 7,400 level. Right. You've noted a key level, the 7340. That's a key level that you've been flagging. Right. So the bulls really have 1 point on the scoreboard right now, but you've also got your eye on the 7250 and the 7,000 below that. When you look at the tape right now, does this breakout have legs, or are you watching for a level that tells you that this move is running on fumes?
No, I think this breakout's got some legs here. Remember something that if there's a heavy volume move to the downside, that means people are getting a little bit worried, a little bit scared. We did see some good volume to the downside earlier this week. We had three down days in a row, which is not real common when in a market uptrend, but we did have that Friday, Monday, and Tuesday. But the volume levels weren't extreme. We did see some rises in the put-call ratio and a couple of other indicators that tend to support the markets. They were going against the market grain the last couple of weeks, but I think this little pullback is pretty healthy. Wasn't very deep. We had a pullback towards the 10-day moving average, the 20-day moving average a little bit further away on the S&P 500, which comes in at about 73.19 right now. So if we do pull back a little bit more, another 100 points or so, it's going to feel bad, but it's probably going to be needed.
Okay. And speaking of peeking under the hood, it sounds like not every cylinder is firing. And if the average stock isn't participating in the rally and breadth keeps deteriorating while the index keeps climbing, at what point does the market stop pretending like everything's fine?
Yeah, I think that once we get into the summer months here, and especially as earnings season starts shifting into another gear, which is more of a slowdown, I think that the catalysts to drive the markets higher are just not going to be there. And I think people are going to anticipate what earnings season is going to look like the next time around, but that doesn't start until the early part of July, right after 4th of July. So there's a whole month and a half from now that the market has to deal with in terms of headline risk, in terms of volatility, and in terms of higher interest rates and inflation. I think that these are things that are negative. Eventually, these things are going to matter to the markets. Right now, they're not, because there's a lot of money flowing into the markets, good liquidity as well. So until people start saying to themselves, "Hey, listen, you know what? Inflation is really not good for companies, and it's going to be bad for margins," we don't see that just yet, but eventually it's going to happen.
Well, does that leave us in a position where really we have to turn our eyes to geopolitics, to the Mideast? We're about to say goodbye to the month of May. So now we're talking about March, April, May with this conflict. We're in a strange kind of holding pattern, but the strait is closed. Energy prices are elevated because of that. Is this a market that's just going to feed off of that from day to day?
I think so, Greg. And the thing that bothers me is that there doesn't seem to be a real endpoint in sight here, and which is why the volatility index, the VIX, is continue to carry a bit more premium. I think in a normal condition or normal situation, when there's no war going on and there's no inflation over here, we'd probably see the volatility index sitting around 15% right now. So, but it's 17, 18, 19%. So there's a bit of a premium there, based on the fact that there's so much uncertainty with the resolution of this war, when it's going to finish, what the outcome is going to be like, and if it is really going to have a more positive effect on energy prices, positive positive effect, meaning energy prices coming down. So I think that those worries are definitely real. And then you throw in the wild card here. We have this new Fed chairman who just started on Monday, Kevin Warsh, who's taking over the committee, the head of the committee. We have a meeting coming up in June. It'll be his first one. We'll have a press conference and so forth. Where's his stance on inflation right now? Is he? I think he's much more hawkish than most people want to believe, but we haven't heard from him yet. We will probably in the next couple of weeks, and I think that. The shift that maybe the Federal Reserve is making right now, which seems to be a little bit more hawkish, is going to have a major effect on markets as well.
Bob, and I just want to talk about, Greg just painted a pretty uncomfortable cocktail. You got obviously oil in the 100 levels, Brent sitting in 106. Inflation risk is now front and center, yet the VIX, you mentioned, it's sitting at 17, basically napping. So is the options market genuinely calm, or is it just not paying attention yet to these macro risks and what it could mean, with the onward effects into coming out of the summer months?
I think it's the former, not the latter, and the reason for that is I do think that the market is paying attention to some of these risks, but they're balancing the risks on the left and the right? So on the one side, you've got strong earnings, you've got good growth, you've got companies coming out and saying good things about the rest of 2026. But on the other hand, you've got all this uncertainty with the war and with the high oil prices and potential higher inflation and perhaps even higher rates on the Fed funds. So I think it's more of a balance here, Aaron, and I do think that there's some acknowledgement there. Why is the VIX so low? It tends to rise when there's a lot of uncertainty everywhere, but we don't seem to have uncertainty with earnings, right? I mean, 27% earnings growth this quarter is fantastic, and those are documented numbers. So this is the certainty. So we are going to log those numbers, and I do think a lot of analysts are taking up their numbers for the rest of this year and into 2027 based on this last quarter's performance.
Bob, I know that you've written recently and highlighted that you're seeing a divergence in the options market in the flows. Bullish into names like Nvidia, we talked about at the top of the show, Amazon, Broadcom, but you say traders are becoming a little more cautious, downside protection in the broader indices. What's that telling us about this market?
Yeah, so we're seeing a lot of put buying in equity futures, S&P 500 futures, NASDAQ futures. And these are just hedging positions, mostly by big institutions. We also see some people buying calls in the VIX, looking for potentially some upside protection in volatility, which would be downside in the markets. However, I think we're, Greg, in a stock pickers market. And I think the stock pickers market provides an opportunity for you to select certain names that are going to do well, certain sectors that are going to do well, and you can stay out of other sectors without having to buy the whole market index. I mean, for the most part, home builders have been very sluggish for the past 6 to 8 months. But if you buy the whole index, you're getting some of those underperformers as well too. So if you've been a select buyer in certain groups, I mean, let's look at some of these memory names have just been talked about over and over and over again, like a Seagate, Micron, SanDisk, Western Digital, and then you look at some of the outlier names on data center like Dell. If you're selective and finding certain names, you can be successful in investing and trading this market. But I think that the passive indices like the S&P 500, the SPY, and the NASDAQ, while they're done well this year, you can certainly beat them.
And Bob, actually, just talking about the indexes, you've also been, one of the ways you measure the put buying is through a put-call ratio, and that's been creeping higher from when it was very complacent levels just weeks ago. So at what point does the meter flip from being sort of a warning signal to an actual contrarian buy signal for you? What's the thresholds you look at?
So I think, when the put-call ratio is rising, that's something you need to be concerned about. When it hits a certain level, let's say over 1, maybe 1.1, and that would only happen here and if the market is really getting pounded and day after day after day, and people are looking for short-term insurance because they don't feel like the market is going to move back up, and they think that there's a considerable downside move left on the market. So they start buying buying this protection, buying far more puts than they're buying with calls. The average put-call ratio, by the way, incidentally, is about 0.60. So something above 1 means people are buying about 1 put for every call. But when it gets up to that level, it tends to be a good contrarian position there, that you take the other side of the trade and say, look, you know what, people are just giving up on the markets here. They're saying, you know what, just take it off my hands. I'm done. I can't stand the pain anymore, and it's time to get back in and buy.
Bob, when we think about everything we've talked about, if we end up in an environment where markets just continue grinding higher, which they have been resilient despite all the the problems we have, volatility stays moderate, you start taking the option strategy, you start thinking about what could work in an environment like this, because there's a feeling out there, investors are worried we're going to get this pullback, but if we just keep grinding higher, well, how could you play that?
Well, in a low volatility environment, Greg, there's some reliability and flexibility within the markets, and what I mean by that is, the market will tend to rise slowly. We know that markets do rise slowly on a regular basis. When it goes down real fast. It's like, as my analogy is always, when the markets are going up, it's like taking the escalator. When it's going down, it's like taking the window. It goes down much faster. But I think some of the strategies you can use are just in a low volatility environment are like, straight call buying and adding some protection with some index puts. I think when volatility is low, and I think 17% right now is moderately low. The historical average on the VIX is about 19%, so we're a little bit below there. When volatility is low, it means option prices are cheap, and that means that not just calls, but puts are also pretty cheap. So you can buy some cheap insurance, but buying some long calls on some individual stocks, and also if you want to buy some protection on those, you could stretch it out and do some vertical spreads, which means buying a call, selling an upside call against it. You're reducing your costs, but you're also limiting your upside when you do something like that. But I do think that you don't need any of these exotic strategies here, like condors or butterflies, to make some money in this market.
Bob, really appreciate taking the time to chat with us. Really enjoyed it. Hope we do it again soon.
Great to be with you both. Thank you. Have a great day.
You too. That was Bob Lang, founder and chief options analyst at Explosive Options. Just a reminder to our viewers that securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Lots of interesting stuff there. I'm going to take it back to the top because, of course, Nvidia was the big news after the market's closing yesterday. Put up some real big numbers. Stocks down about 1%. We talked about the broader trade, and Bob's saying, the broader AI trade, he thinks some of those trades have room to run. And he bought quantum names back too, right? Because remember, for a while, people were, quantum's the next thing, and then it sort of died down. So it's interesting that's back in the mix. But ultimately, talking about a stock picker's market, you don't have to buy the whole index because people are getting worried about this market right here.
Absolutely, Greg. I mean, when you look at the mix of the indexes, looking at S&P 500, there's just a handful of names that are obviously driving that index higher. Most of the investors are already piled into it, so that's kind of how he made that notion. And one of the things that I think was interesting that he mentioned, of course, when you look at the broader risks, we're grinding higher. Everyone's trying to think, okay, we're at the tops. When we came out at the start of the year, Greg, we were talking about what's the S&P going to end up at the end of the year. Numbers are ranging from 7,300, 7,500. Well, we're mid-year right now. We've got an Iran war that no one really predicted at the start of the year. And we're sitting at about 70, just shy of 7,500. We're at the 7,400 level. But I think when you throw the big sort of mix into it now, the inflation picture with Kevin Warsh coming in and being more of a hawk than even Jerome Powell, what that would mean and if we're going to get any rattling effect right now. But the VIX obviously is not suggesting that. So it's obviously, he ended up nicely in saying, this is a market where you can still go long. Options are obviously priced accordingly with the VIX sitting where it is. It's not as juiced up as the premium would be had the VIX been much higher there. So a lot of things to chew on there.
Definitely living in interesting times. I don't know how I feel about it, but they are interesting. If you'd like to learn more about options, scan the QR code on your screen to explore Options Education Month at TD Direct Investing. Throughout the month of May, we're going to have live shows, including TD Active Trader Live, along with workshops, Q&A sessions, and on-demand content designed to help investors build their options knowledge. Whether you're just getting started, you're looking to sharpen more advanced strategies, we got Everything you need. We also want you to hear from you. So send us your questions, feedback, or topics you'd like us to cover. After each show this month, we're going to select one lucky viewer. You can see it right there on the screen. Win some of this TD Active Trader merchandise we have here on the set. Just email us at td.activetraderlive@td.com for your chance to win. It is time now for Technical Take. The stock in the spotlight today is Deckers Outdoor, known for its footwear. So maybe you own a pair of Teva sandals or Ugg boots or Hoka running shoes, or maybe all three. Maybe you're that well-heeled. Well, that is Decker Outdoor. So while the company has a strong brand offering, it's also facing increased competition, rising costs, and inflation-weary consumers. So we got results expected after the close today. What are the charts telling us? Let's go to Hiren. What are your thoughts here, Hiren?
Yeah, Greg, before I jump into the charts, I just want to mention a couple of things coming with earnings tonight. Obviously, you mentioned some of the brands under Deckers Outdoor Sports. Hoka is the primary growth engine for them. That's really benefiting from sustained demand in both performance and lifestyle footwear. But this is a company over the last 5 years. They have done double-digit growth, Greg. This is the fifth consecutive year of double-digit revenue as well as on the EPS. That's a CAGR of 19% on the revenue side, 32% on the EPS. So there's a lot of tailwinds behind it. For this quarter especially, there is going to be a bit more turbulence expected with Q4. Expectation on EPS is 81 cents. That does mark a 19% decline year over year, and a revenue coming at $1 billion, $1.08 billion, which does mark a slight increase at just shy of 6% there. The big news, though, of course, is going to be obviously the tariff story. That was what had shaked out in 2025. Since then, Deckers has now less than 5% of its production from China, and they've really massively de-risked that, and a lot of that is now gone to Vietnam, where there's about 14 tier 1 footwear factories as the primary production hub now for footwear across for a lot of these brands here. But if we look at the charts, Greg, what we've seen is that a reflection of that. I'm just going to peel back a little bit over here, and we can see when we went up to this significant high parabolic move just at the start of 2025, we were sitting at about 225. This is just at the onset of the tariff liberation day, heading into it. That first earnings kind of in that mid-March, we saw the big pullback, and then, of course, the whole tariff narrative started right into May, and we can see how much the stock got punished. Almost this had decimated the stock about $128 from its high. That's 134% sort of a drawdown. But since then, one thing you've got to understand with this stock, it is very volatile, especially during earnings. Had some huge gap down events leading up to earnings. This was a gap up, but it was swiftly pulled down. So bears were really trying to wrangle this stock in. Here's where we find ourselves in currently. We have seen the lows bottom out over here in this kind of 76 zone. This is a demand zone. I marked the 75 to 90. Anytime it's come off here, multiple times you can see it's rejected off of here. We're sitting just shy of the 100 level mark right now. We're sitting at about 98 at the moment. It has formed a telltale head and shoulders pattern. But this pattern is not complete yet, Greg, because we did get a sort of a failure on this pattern. Typically, when it gets down to this base supportive line, this is kind of the line in the sand where it breaks down below. We could see some further downward pressure, but it does require a catalyst event, and we've got one tonight. And that's what we're going to be waiting to see if there's further tariff news that's going to be impacting them, and also with inflation peaking up, what does that mean for people's wallets and spending in the footwear business there?
Great, a lot of questions we want answered after the close, but right now, you're going to walk us through a couple ways we could trade Deckers Outdoor. Before you get going on that, just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Here, and take it away. You're going to start bull or bear for us.
Let's do the bullish case, Greg. We'll see what with the way the bulls are setting up the charts right now. So, Bob mentioned this, like given the current environment that we sit in and where the VIX is sitting in, to look at going, if you want to look at doing the long play, one of the ways you could do it is by doing a spread strategy. And that's exactly what we're going to do. We're going to pivot to bullish spread strategy and a bearish spread strategy. So looking on the bull side, we're looking at a bull call spread trade. We're looking at these levels where we see the stock tend to bounce off of. So one of the ways is to buy the 95. That's slightly in the money call. We're going out to the June cycle, giving ourselves a bit of time heading into this earnings in case it doesn't shake out in our favor. and then looking to cap our upside potential with the 105. Now, the reason I want to do this is because I want to collect a bit more premium to lower my cost. In this case, we're looking to get into a debit of $3.50 on a single contract. That works out to $350. That positions our break even right at 98.50. So essentially, I need the stock to remain above 98.50. Now, when I set up this trade, of course, this was midday yesterday. The stock has moved obviously above that break-even level. It's sitting just above it at the 99 level right now, but we needed to stay above higher. Ideally, we wanted to get to that 105, and I've got that roll cue for you, Greg. We're going to look at those big numbers here, what could happen. And I'm just going to pull that up over here. So if it does get to this 105, this is where we stand to gain the max on the trade, and that's going to be $6.50, in other words, $650 on a single contract. Now, we're obviously looking at the downside, of course. I've kind of done this visual bar graph over here, and that means if we stay below 95, then we're going to lose essentially what we put into this trade, and that's the $3.50 is what we stand to lose should Decker stay below $95 by our June expiry date that we're holding out till.
I like that visual bar graph. You use it on Tuesday's show too. I like it.
Yeah.
All right, so that's the bull side. What about a bear side?
All right, so bear, we're going to do the exact opposite trade. Now, if you are expecting that, they're going to run into some more headwinds, one of the trades you could do is what we call a bear put spread trade. Now, in addition to the VIX, one of the things we look at, Greg, with options, we look at the actual implied volatility of the stock itself and kind of where it sits according to its previous implied volatility levels. This is kind of smack dab in the middle. Given the VIX backdrop, this again is reaffirming to us that going long is going to be beneficial in terms of the way the premiums are priced. Expected move for the earnings is 1560, or at least I should say not earnings, but the July cycle over here. So in a bear put spread, we're exactly taking the same strike. So we did the call 95 long speculative. On the downside, we're seeing this is kind of the line in the sand level. We're buying the 95 put, which is out of the money slightly right now. And we're looking to see where the last time the stock tested and got some and saw some more demand, and that was around that 85 level. So we're doing a 10 width or 10 point spread over here. This one is costing us essentially nearly the same. And what the luxury I had with going bearish, Greg, was I was able to extend it out to the July cycle, and still this was being cheaper than going to the June cycle. So anytime I can buy more on the trade, that's going to reward me on the cost from the cost perspective. I'll take the extended time frame, and we did, and we're able to get into this trade for $3.50. It's probably cheaper now given where the stock has moved up, and we're looking at some possible upside and downside, Greg. So here's how that works out. 85 is the level where we make the max upside, or I should say theoretically downside on this trade, but again, and that'll be again $6.50. Again, it's $10 minus the cost, $3.50, $6.50 or $650 on a single contract. Where we stand to lose on this trade, of course, is if it doesn't move down and instead continues the run that it started over here. In that case, we're going to be out of a pocket $3.50 or $350 on that single contract that we have there.
All right, some interesting possible strategies there. Thanks for that here, and that's almost our show for the week. As always, investors should perform their own due diligence before engaging in trading. We will be back on Tuesday where the debate will be. What's the debate going to be?
We're debating a company called PanW, also known as Palo Alto Networks. It's a cybersecurity company, Greg. So that's what we've got on deck for Tuesday there. So it'll be interesting, especially with the whole AI backdrop and how that's shaken up that industry as well. Apart from SaaS, the AI space, or I should say the cybersecurity space, has been seeing a bit of pressure there.
And Jay got the bear, right? We did the live flip, and Jay got the bear.
Jay did get the bear on this one, I believe. So I'm going to be vouching for the other side and fighting against AI on this one.
You don't want to miss it. It's always a great time. But thanks for watching, and we'll see you on Tuesday.